Welcome, everyone. Today, we look beyond the surface of what many mistakenly believe to be a purely mathematical field solved with neat formulas and spreadsheets. Successful investing is not about solving complex calculations or reading balance sheets faster than others. The history of financial markets is actually a grand human drama driven by greed, fear, and instinctual behavior. Today, we will explore the core behavioral patterns and action designs required to survive market madness and build lasting wealth. We often obsess over visible numbers and macro data, what the central bank's discount rate is, how high the market volatility is, or how our portfolio performed this quarter. These are factors we cannot control, what we call the external game. The true decider of long-term success is the internal game, mastering greed, overcoming panic, and keeping our own egos in check. No matter how brilliant your analysis of the outer indicators is, a failure to master the inner game will make all your knowledge useless in an instant. When you study asset allocation in a clean, quiet college classroom, every portfolio looks perfectly optimized for constant upward growth. But real-world investing is a wild jungle where egos and raw survival instincts clash every single second. In this jungle, the winner is not the hyper-intellectual analyst trying to avoid every single penny of loss. The ultimate survivor is the one who possesses a flexible, reasonable strategy that allows them to remain in the market even during the most brutal downturns. Numerous studies in behavioral economics show that the human brain processes the pain of financial loss twice as intensely as the joy of equivalent financial gain. This is known as loss aversion bias. When the market enters a downturn and paper losses mount, the logical, analytical parts of our brain shut down, and the primal cells responsible for fear and survival take full control. This blocks objective evaluation, forcing investors to panic sell quality assets at the very bottom just to escape the mental agony. Even rational individuals lose their sanity within a crowd. Confirmation bias spreads like a virus, feeding herd behavior. Eventually, investors fall into an information cascade, blindly buying simply because everyone else is, mistaking crowd safety for real security. Believing that safety lies in crowd numbers is the quickest way to find yourself pushed off the edge of a cliff. The financial markets we trade in ride on the gears of a massive macroeconomic machine. The global money supply, or M2 liquidity, acts as the fuel that lifts asset prices. On the other hand, the central bank's discount rate acts as a heavy gravity pulling valuations downward, while inflation policy steps on the brakes. These giant macroeconomic gears turn relentlessly day and night, showing absolutely no regard for our personal portfolios or financial situations. Throughout history, the names of hot assets and the marketing slogans of technological revolutions have constantly changed. From the dot-com bubble of 2000, the housing crash of 2008, the unprecedented pandemic-era monetary expansion of 2020, to the recent AI revolution, the packaging changes, but the underlying rhythms of crowd mania, greed, and panic remain identical across generations. Getting rich and staying rich require two entirely different and opposing skill sets. Getting rich demands taking risks, maintaining optimism, and focusing capital. However, keeping net wealth demands the absolute opposite: extreme humility, acute awareness of sudden market shifts, and a healthy dose of paranoia about losing everything. Balancing a bold offense with a paranoid, defensive shield is the ultimate secret to long-term financial survival. A close analysis of investment history and business success reveals that long-term outcomes are not driven by everyday average returns, but by a tiny fraction of tail events or extreme outliers. In Warren Buffett's vast portfolio of hundreds of companies, the vast majority of his wealth was generated by just a handful of outstanding businesses. Index investing works the same way. A few tech giants pull the entire index upward. Your goal is not to predict the future 100% of the time, but to survive long enough to benefit when those rare tail events occur. The greatest investment legends never arrogantly assumed they could predict the future. Ben Graham relied on a margin of safety, buying assets far below their intrinsic value to protect himself against his own errors. Charlie Munger avoided stupidity by using a multidisciplinary latticework of mental models. Ray Dalio engineered the all-weather portfolio to defend against all economic seasons. They were not prophets, they were simply wise builders who constructed strong arcs before the storm arrived. It is time to look beyond our brokerage statements and honestly evaluate our own behavioral balance sheets. In the liabilities column, you will likely find emotional debts, FOMO, the tendency to avoid looking at your account during a crash, and herd mentality. To offset these liabilities, you must build up behavioral assets, a cash buffer for a margin of safety, automated investment rules, and the humility to admit when you are wrong. Only when your assets outweigh your biases can you remain truly resilient. Do not make the mistake of relying on your own willpower to make trading decisions during a market panic. Under stress, anyone is prone to emotional mistakes. The most effective defense is to design a nudge system. Automate your investments so a fixed percentage of your paycheck immediately flows into low-cost index funds on payday. Isolate your emotional ego from the decision-making loop, and let the system run the marathon for you. The true, awe-inspiring power of compounding is that its massive gains are heavily backloaded, occurring at the very tail end of the curve. The fact that over 90% of Warren Buffett's net worth was generated after his 65th birthday is a powerful reminder. Instead of chasing dangerous, high-yield gains that risk complete ruin, aim for consistent, moderate returns that you can repeat over the longest period of time. Time is the ultimate multiplier of wealth. The ultimate purpose of investing in enduring market volatility is not to show off luxury goods or buy social status. It is to secure the control over your own time, the ability to wake up and say, I can do whatever I want today, with whoever I want. This is the supreme dividend of wealth. The moment you define your own enough and stop playing the endless game of comparison, you break free from the chains of money and become its true master.